Hello, and welcome to Connected With Latham, where we discuss ideas, legal developments, and business trends shaping the global economy. I'm Haim Zaltzman, partner and global vice chair of Latham's Emerging Companies and Growth practice. In this episode, I'm joined by Ankit, partner of NewView Capital, a California-based venture capital and growth firm. Today, with $3 billion under management, NewView invests in high-potential technology companies on a primary, secondary, or a hybrid basis, complementing flexible funding with the operational impact and trusted connections needed to realize scale and build value. Ankit, welcome to the episode.
Thanks for having me, Haim.
Ankit, before we dive into NewView Capital, I want the audience to get to know you, your background, and your journey, and particularly how that ties into NewView's mission, your investment philosophy, et cetera. So can you jump in and tell us first why you're passionate about investing in technology and how did you end up in NewView and help develop the platform?
Sure. I've always been interested in technology. It's being around an ecosystem that is changing the world, of course, but also changing so rapidly itself. That is quite exciting. And investing was just the way I found to do that. So, I did the traditional path, investment banking, went to a larger investment shop, doing growth equity investing at General Atlantic. And then when I met Ravi, he was starting NewView after his 15 plus years at NEA. And the pitch he gave me really resonated, which was, hey, if you want to spend your time meeting thousands of companies and investing in hundreds of companies, this isn't the place for you. But if you want to really have a core group of companies and investments that you will spend time with, founders that you will help, and relationships that you'll build over time, then that's what I can promise. And so that is what we do at NewView. We take a boutique approach to venture. We make a limited number of high conviction investments, and we support those companies over the course of their life cycle and are prepared to, really be decades-long partners with them.
Can you tell us, particularly in the current environment, how your views on the investments in a portfolio has changed, what you guys are focused on right now in terms of the NewView aperture? It would be really great to hear how your background has led you to focus on fintech, SaaS, and how you view that in the current environment.
Yeah, I think more than sectors and verticals, it's about high quality business models. And I think that remains true whether we are in an AI cycle or whether, as we were, 5 or 6 years ago, in kind of a post-COVID cycle as well. Those realities about quality business models remain true. And you can see that across the investments we make. As you mentioned, most of what we do is B2B, whether that's, software, AI, fintech. But if you think about our portfolio, there's a few B2C models in there as well. And there's a reason for it. It's because despite it being, quote unquote, outside our wheelhouse, we felt like they had the recurring nature of a software business. They had the customer love of and network effects that wouldn't exist otherwise. And so we try to see beyond the rules of where we're supposed to invest and take a step back and look at the higher level picture. I think AI is that same opportunity, really, where what's happening today feels frantic and everyone's trying to wrap their head around it. But we happen to believe that if you stay pretty focused on highest quality business models in any given trend, that we will do, right by ourselves and our investors.
Yeah, and right by yourself and investors is an understatement for the audience. I mean, NewView has been an investor in some of the best tech names out there, from Bloomreach to Eucalyptus to Hims and Hers to Human Interest to Legora to Modern Treasury to Mercury to Neum, CoreLogics, and a bunch of others. So clearly, you guys have had great access. And when you talked about the relationship and the boutique approach, that's been very attractive to some of the best names in tech. Can you discuss just quickly from a high level, if when you approach companies, do you approach them with that boutique kind of we're not X, we're not Y, this is what we're trying to do? I think the audience would really love to hear kind of NewView secret sauce to getting access and obviously the conviction to help support some of these top names.
Yeah, I think if you're trying to build a boutique venture fund and you think about what a portfolio should look like, there's really two approaches. You can go after companies, spaces, geographies that are otherwise untouched by the largest venture names, or you can go after what we think are the highest quality highest return potential companies, in which case you really need to make an argument for yourself over those larger names. And the argument we make is to be very eyes wide open about who we are and how we differ from the large venture platforms and say, look, we are by definition intentionally an orthogonal approach to the folks you already have on your cap table. And so bringing us under the tent brings a different level of value add and a different perspective that, frankly, we rely on our founders themselves to speak our praises. And if you look at our website or the content we put out, or frankly, when we need to win a deal, the first thing we do is direct folks to our founders who speak for us.
Great. And obviously your founders, and you mentioned geography as well. And you also mentioned product lines. And I think when initially I introduced NewView, I did note that you do primary, secondary, and hybrid. And, as a lawyer at a law firm that handles a spectrum of deals that maybe no one else covers, you guys truly are one of the leaders, particularly you were early leader in secondaries.
Yep.
So I have two specific questions. One of them is about geography, and then the second one's about the product side. On the geography side, we've done quite a few deals with you guys internationally, including in the Middle East and Israel. So I would love for you to discuss any geographic focus, where you see geographically some of the better companies and technology develop, and whether you think that's going to be on a go forward basis as well. Like, where does NewView in the world focus? And then the second question will be about secondaries, your initial strategy on secondaries, how you guys became some of the leaders, and how you guys think the secondary investment platform will continue going forward. So we'll start with geography, and particularly Middle East, Israel. It's obviously a quote unquote hot area right now for both good and bad reasons, but we know that's been a huge investment focus for NewView.
It has. And really the reason we chose Israel was not because we identified it as a hotbed of technology, which of course it is, but because we take a pretty thematic approach and we try to map the market regardless of where the companies are based. So a great example is HR software has been a really great place for us to invest. We identified companies across the world building and innovating in this space. And it just so happened that one of those companies, HiBob, that we identified is based in Israel. They serve the world. They serve our companies, in fact, our own portfolio companies across countries and regions. And they just happen to be based in Israel. And I think that repeated itself with CoreLogix, where in the observability ecosystem, we saw their approach as being distinctly differentiated, and they happened to be in Israel. And I think that happened enough times that we actually probably graduated Israel from the company happens to be there country to a central focus where I and the team spend a considerable amount of time visiting every year to make sure that we know what's happening in that ecosystem. So I think that country itself is probably the exception. So our focus area, of course, we're Bay Area, we're US based. We also look at Israel. And then across the world, whether it's CloudWalk in Brazil, Neum in Asia, Legora in Europe, we're really looking for the best companies regardless of where they're based. We really think of it as being thematically focused, not regionally focused. So when we go deep on a theme, the idea is to meet every company, meet as many customers, meet all the experts, and form a view, and then take a pretty, I'd say, unbiased view as to the best company to back in the space. And very often, geography has nothing to do with that.
Interesting. The thematic is actually a great segue to the second question.
Yeah.
And that's on secondaries. And you guys were, and again, giving you kudos, were the leader in secondaries, setting up SPVs for secondaries, making major secondary purchases earlier than before it became, the total standard. I mean, I would say now that we look at, particularly with the slowdown in the IPO market, secondary transactions have been the dominant force in the transfer of dollars in the venture community. And you guys were very early on that. Can you talk about your history with secondaries, what you did, what the plans are, and how you see that product line change?
Yeah, our origin story itself was, in effect, a very large secondary out of NEA, where we purchased 31 positions from them.
That's right.
For $1 billion on day one. And that was a incredibly unique transaction. It allowed us to start a growth fund in a sort of accelerated manner, but it also gave us insight into a problem that was happening across the industry. And so when we think about approaching companies, we're always thinking about what their product market fit was or is. And similarly, our product market fit in a lot of respects was taking this problem that was occurring, lack of liquidity, and figuring out how to productize it. And so NEA was our first customer in a sense. We've gone on to transact with dozens of venture funds across dozens of companies. Secondaries are a critical part of our strategy. And we look at it two different ways. One, it's solving a problem for those stakeholders, whether they be employees through employee tenders, founders, investors who have been in the company a long time, and even LPs who are expecting distributions from their VCs. But it's also solving a problem for us because we feel that it is, in a lot of respects, the best risk-adjusted way to play venture growth today. And we think that part of the reason for that is because not enough people are doing it. But as more enter the market, as has happened, as you alluded to, it's become more of a standard. We still believe that there's a lot of opportunity there.
I mean, it's really interesting, Ankit, what you just said. And I'd like to double click for the audience and maybe have you say a couple more. The whole concept of a risk adjusted way in the venture world, that's not a phrase you would typically associate or link to venture investing, particularly not a decade ago, because all the hockey stick way, right? You either get the 1 out of 10, you shoot for that star. But the risk adjusted way, particularly a later stage, is becoming more and more the investment platform for others. And you guys were in the lead of really looking at that. Can you tell me a little bit more about the way you guys think of what risk adjusted means in venture, where you don't necessarily have cash flow at all? It's not EBITDA positive by any means. Maybe you have some revenue, maybe trending towards revenue, maybe significant, but it's on that spectrum. What does risk adjusted mean for NewView?
I think it's just another example of venture's evolution in the same way that private equity evolved. So private equity has evolved to use a whole host of tools to improve their returns, to improve the product for their constituents. And similarly, venture is doing the same thing today. Secondaries are one of those tools, and secondaries themselves take a lot of different forms. LP stakes have happened within venture for a long time. What we have popularized is the idea of liquidity to the other stakeholders as well. So normalizing founders taking some chips off the table at the right time, normalizing employee tenders. We did 7 last year. This is becoming by far and away the fastest growing part of the secondary market. And you're seeing some of the biggest names in tech do it.
It's totally standard. You guys have really, I mean, it's become common, right?
Yeah. And we did our first tender, I want to say in 2019, which was months after we were founded. We led a tender in Plaid for a company that knew they had to go the distance. It really allowed them to give liquidity to their employees who had deserved it along the way and kept them focused for the next 6 years since.
Yeah, it's amazing what it's at. So where does it go for now? What's going to happen? Because I mean, I'm telling you from our experience at Latham Watkins, including doing these transactions with NewView, Ankit, is we're seeing more and more demand for the secondaries. It's becoming standard on basically every investment. Almost every acquisition is starting to get layered into it. Where do you see the market going near term, and what does that mean for the IPOs in the public market?
The folks who are probably most squeezed by the growing popularity of secondaries are the secondaries only funds. And these are folks who are generally seen as asset managers. They view themselves as stock pickers. They tend to be highly transactional. And what they now have to contend with are mainline venture funds and funds like ours contributing to that environment and outcompeting them by being closer to the action, closer to the founders, closer to understanding of the product and trends. And where we see opportunity is that we can be that hybrid partner. We have led primary investments and primary deals where we've layered on secondary either alongside the deal or years later. Human Interest is a great example where what started as a sort of a co-lead of a Series C led to us deploying many times that much capital over the years as early investors needed liquidity. And we built that into a large position that we're very excited about. And along the way, we think we added value to those who took some chips off the table as well, and they were happy to transact with us.
Yeah, I mean, that's super. And again, for the audience, it's going to be another key takeaway. We mentioned earlier that NewView and obviously lots of other VCs can do primary, secondary transactions. Those are what folks focus on. But the question, and I think the answer as well, is whether, the VC model has evolved to be hybrid, that you have to be able to do primary and secondaries. And if you don't, you may be at a disadvantage, at least for some of the top names. Would you say that's definitely the case, or at least that's definitely how NewView looks at it?
That's certainly how we look at it. And I would say that from my conversations with other funds, they have started to look at it the same way. In fact, when I speak to folks who aren't registered advisors and have a 20% cap on the secondaries that they can engage in, almost everybody is maxed out today.
Interesting.
And those who have taken the step that we took to become registered and to focus on secondaries, we're quite excited by that. It's normalizing a transaction that we spent years trying to bring into the light, if you will. And now that it has become a standard part of the venture ecosystem and what companies and startups expect, we just think that there's going to be more to do.
That's super. I'm taking a moment because I do think that is a huge takeaway, that the venture capital model has now evolved where we rarely see successful, or at least it's not likely going to have a lot of traction if you can't do both primary and secondaries on every given transaction. And that's definitely what we've been seeing in the market as well. So super interesting. Great segue more generally to move towards the macro trends. This is something I try to cover on every episode. And Ankit, for you, the question is, what's the most challenging aspect right now? Is it the tech company specific stuff? Is it the impact that AI is having on SaaS? Or is it just the broader macro challenges? Is it, the geopolitics, the instabilities in certain markets, the ups and downs in the public markets? What is it more company specific micro, or is there more broader macro that's really keeping you awake?
I think here in Silicon Valley, we don't do a great job of appreciating the broader macro. So I do think that it has a role to play, and everything from the regulatory environment's impact on fintech to the macro environment on business confidence and therefore IT spending does have a big say in how some of our companies perform. That said, right now, given the shifts that we're undergoing with AI, that really is top of mind. And I think if you think back to what we were talking about, our duty as company builders alongside these founders is to make sure that we're with them every step of the way. And so while it feels like the industry has forgotten about their existing portfolio companies who are going through a challenging time right now in the face of AI, we certainly haven't. And we are trying to spend the time and cycles with companies that are reinventing themselves. And we think that that reinvention is actually one of the most exciting things to be doing today alongside your net new investments. It speaks to what we feel our priorities are, which is continue to find the next big thing alongside being incredibly supportive to those founders who've trusted us to begin with.
So is there a NewView, Ankit, playbook for reinvention? Give me the top 5 things that you guys are talking, or top 3 things if easier. I like 3 to 5. Those are the numbers I really like. 4 is an unlucky number apparently, so I should avoid it. 3 to 5 things that is the NewView reinvention playbook. These are the things that you guys I need to make sure with our portfolio companies, I need to make sure with investments that they're hitting with respect to AI right now and the impact that the AI revolution is having.
Yeah, I think that we have a pretty great front row seat to this reinvention that's happening. And I can point to a couple of great examples. Companies like Intercom with their Fin product are, I would say, leading in a very large AI-dominated space. Companies like Reltio, which just announced its acquisition by SAP, found a way to make its data management product even more relevant in the age of AI than it was in the prior generation. And I think there's a few things that these companies are doing really well. I don't know if I can narrow it down, but at the very least, everyone is changing their narrative. So it's easy to add a .ai to change your website. I don't actually put that on the list.
Interesting. You think actually changing the narrative is now the market is seeing through that. It's not worth
It's not worth it. And in fact, you are guilty until proven innocent when it comes to these companies who were formed in a prior era.
Again, it's just a great line. Unfortunately, this is sometimes the way the business world works because the markets are short-term are a voting machine and long-term are a weighing machine. And that means you're basically guilty until proven innocent. So in the initial term, you should expect the vote to be guilty until the measuring machine gets you to a different result. And that can be frustrating and take time.
And I think that's true not only for the way that your investors or prospective investors or the public markets will view you. I think it's also true of the way your customers will view you. Because today, more than ever, customers themselves are well informed. They aren't looking to make decisions on their technology stack that will keep them in a prior generation. They're trying to make sure that they are future proof. And so the narrative shift is required. Everyone's doing it. It's important, but I would say that it's table stakes. And really, reinvention comes down to product itself, where not every product in its current form is relevant for the next era. And the best founders are taking a completely objective approach to evaluating their product today, meaning shutting down products that are no longer relevant for the AI era, building new products that benefit from years of data that they've gathered, and really being pretty disciplined in how they think about business building, not clinging to the successes of the past. And I think there's many examples across the portfolio where I can.
So is something you said is different than a lot of the answer, the way I think about it is the customers. Are the customers the lodestar for the founders, for management to where the AI? Because that's actually a very important directional thing, because there's lots of noise everywhere.
Yeah.
Right? We got lots of stakeholders in every business, whether private or public. Obviously, some of it's impacted more in the public, right? Because it's more violent, it's right there. But some of these concerns are similar to all of them. Is that the lodestar?
It should be.
Okay.
It should be. I think the investor universe is fickle, and having them as your lodestar is a dangerous game to play. Customers who you already have relationships with, are the ones who are going to test your product and tell you whether you're onto something. And so I think the things you have to change with those customers is not only, as I mentioned, building net new products, because the pace of development has increased and the ability to build products has increased, but also to figure out how you're going to add value and claim that value back, whether it is changes in the way you price or monetize your product. So both the examples I gave, Intercom and Reltio, have done an incredible job changing the way that they monetize away from seat-based pricing to usage-based pricing. As an example, Reltio uses an MCP server for customers to access data that they otherwise would have a difficult time accessing across multiple systems. And it's allowed some of the largest enterprises in the world to A, use AI with the stack they already have in place, and B, derive the kind of ROI that wasn't possible in a software-only world.
I mean, your answers are kind of leading me to take a view that, NewView and you, Ankit, have a very optimistic view on AI. This is a chance to reinvent. It's a product line versus a more defensive, pessimistic view of, hey, the downside risk, we got to protect that. You got to focus on the customer and shift towards that optimistic way. This is your chance. You got to do that rather than just be defensive and try to hold on to the structure that you have, the contract. Is that a legit statement?
I think you're right that I'm optimistic about companies' abilities to reinvent themselves. And almost every company is trying to do this today. But there's also a reality that not everyone can do it. Not everyone will make it. It's an incredibly difficult path. Not every product is relevant in the next era of technology. And so it's not for everyone. It's certainly not for the faint of heart. I have an incredible amount of respect for those founders who have found a way to make this reinvention happen for their companies, but it's not for everyone, and it'll be a harder path, and I think people understand.
But you have to have that conversation, right? Okay. Is NewView sometimes being the initiator of, hey, how are you guys reinventing, or is it the founders and the management doing it? It sounds like they're doing it a lot of themselves because they're feeling it, they're coming to you guys. How are you guys taking part in that reinvention conversation and channeling them towards, hey, this may not be a product, you may need to let go of this product, versus here are some of the others, this is where the customer is leaning? Because obviously everything is moving really fast, probably the fastest cycle we've ever had, obviously since COVID, which was brought upon us rather than forced via a technology layer. How are you guys having those conversations?
Founders are definitely coming to us. They are not ignorant about what's going on. They're facing these issues and they're coming to us to help them work through it. I think if you say as an investor that you are in service of your founders, in service of your companies, then your actions better back that up. And so as an example, What we've been doing more so in the last year than ever before are customer calls with companies that are already in our portfolio. So we're going out there and speaking to customers of our portfolio companies. We're speaking to customers of their competitors, customers of the newest AI products, and trying to understand where the needs have changed to and take that information and deliver it back to those companies. That's not in our traditional job description, but I think the best investors don't really think in the sense of a job description, and we're more so than anything in service of those founders.
Interesting. I mean, that's again a lot of things to digest for the audience between the lodestar and the customer being the lodestar, and how do you work around it, and then having that true conversation about reinvention. Those are things that every founder, every company, every board obviously needs to be top of mind. I want to move to the last part of the episode and my favorite. It's what I call the speed poker round. So I'm going to ask you a series of questions here, Ankit. You get to only give me one answer. You can explain the answer, but only one answer, right? So you can't, no hedging. This is the no hedge section. You know, I'm a big fan of poker. I think it's the best stochastic game. There's lots of things that are relevant for it. But anyways, let's start with the first question before we get into the final one, would be the poker one. What's the biggest professional obstacle you faced? One thing.
I would say choosing a job for the wrong reasons. You have to know what matters most to you, and it may be different from what matters most to someone else. And I think that level of personal insight goes a long way.
And give me a couple of things, like what?
Perfect example is, turns out I'm not really interested in finance. I'm interested in technology.
Okay.
And so choosing a job because it's closer to technology, closer to founders, closer to products is what makes me most motivated.
Very interesting. Brings me back to the lodestar. What's your personal lodestar, and the closer you can get to it? Although I will notice that even though you care more about tech, your job still involves elements of finance. So
absolutely,
there's a lot of stuff in the world. I have this conversation with my associates all the time. Like, none of us get to do perfectly, exactly, and only the exact thing that we're super, super hyper excited about. There's lots of other stuff where you have to roll up your sleeve. You still have to do it. It's part of the business. It's part of et cetera. So, and I think obviously for you, like, you're a venture capital investor, tech is your lodestar, but you still have to understand finance. You still understand cap tables. You understand supply chains. You still understand broader economy. So,
and as long as what I'm working on is with that end goal in mind, to be closer to those industries, it turns out everything else gets easier as well.
That's actually very important. It's great. It's a great statement. Next question. What's your ideal teammate? You can pick one. Someone who has education, experience, or the right temperament.
I've got some pretty ideal teammates around me at NewView already, and it's a no-brainer for me. It's temperament of those three.
Why temperament?
I think of temperament as keeping it cool through difficult conversations. So disagreeing with people, challenging them, and still coming out the other side as teammates is, I think, critical. And it's the type of, investment committee discussion that we try to get to. It's the type of hallway discussion we try to get to at NewView.
Okay. Now we're coming to my favorite question, the poker table question. So you're sitting in NewView right now, Ankit, and you get to change or adjust one thing, and only one thing. Is it the game itself, broader economy? Is it the table, the VC industry, the investment industry broadly? Is it the house, the regulatory regime, the government, fiat, et cetera? Is it the stack of chips, i.e. how much cash you guys have, the fund size, ability to allocate cash, et cetera? Or is it the other players? Someone's not playing nice in industry, you're not coordinated enough, and so on. One thing, what do you do?
I mean, Haim, if you're offering me a stack of chips, I'll take the stack of chips. That's the issue.
Everybody wants a stack of chips, but that's also that
the opportunity is large enough to support it. You really want to be careful that you're not asking for a stack of chips and going all in when the person in front of you doesn't have much to offer. But in this case, the opportunity is massive. And in order to do that well, of course, you need a stack of chips. So if Haim's offering it, I'll take it.
I'm offering. I just have very limited stack of chips to give you. Although for the audience, I am a very, very small LP in NewView, so I'm very, very happy about that. So they have my chips, but it's very limited. That will not move your stochastic result on the poker table. I mean, it is a very exciting world right now with all these options and the AR reinvention. And you do think larger dollars, ability to actually allocate will change results and consequences? It's something that you guys think about when you're making an investment, is how much more cash the company will need. I know that's always been an important thing in VC investing, but is it more so now in light of the capital intensity that the companies need, in light of the need to buy compute potentially for a lot of players and to access that, which is not free. Do you guys think more about the cash that's needed for a company than you have in the past?
I think we are encouraging companies to have more than a comfortable buffer of cash, more so because the most exciting companies today are pivoting along the way. They're pivoting even at scale. I mean, you're seeing companies that are trillion-dollar companies decide whether they're consumer or enterprise focused, for instance. And so in order to do that, you need resources, you need cash. I think in this environment, you probably don't need as much as we might have needed in the past to develop the next new product, but runway gives you the right to pivot and explore and find the next big hockey stick opportunity.
All right. Well, speaking of sticks or hockey stick, sports always make me think of food. So my last question is, what's your favorite food to eat at work or when you're playing poker or any other games you play?
At work, I'm sort of obsessed with these electrolyte things called Element. They're like the saltiest drink you've ever tasted.
Oh my God.
It makes no sense, but instead of caffeine in the afternoon, I'll do that.
Does it
And
give
it'll
you like a
keep me-
boost?
For whatever reason, it does. It's nothing. It's just salt. To be honest with you, it's completely psychological at this point. But if it keeps me from caffeine in the afternoon, which it has done, it has been a lifeline to me. So you'll always see me with a huge can of Element around the office. And then playing poker, I think you have to eat pizza, don't you? Isn't that the rule?
I mean, you'd be shocked at how few people say that as an answer. It is the easiest one. And then we have some fancy folks here who like their sushi and other stuff.
While
Yeah.
playing poker?
Yeah, well, it's this is what you get. I know, right?
Count me a traditionalist.
Ankit's a true pizza guy. Well, look, Ankit, true pleasure to have you on the podcast. I really appreciate you coming in. Thank you so much.
Thank you, Haim, for this, but also for the partnership with NewView over the years.
I really appreciate that. Thank you for our audience and for checking out this episode of Connected with Latham. You can subscribe and listen to new and archived episodes of Latham's podcast on lw.com, Apple Podcasts, Spotify, or anywhere else you listen to podcasts. If you have questions or would like additional information, please email us using the links located in the show description. We hope you'll join us again next time. Thank you.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things. And you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 1271 Avenue of the Americas, New York, New York, 10020. Phone number 1-212-906-1200.